I think our politicians need to think about the rate of the transition as that same brake or accelerator on the economy, and that if we find ourselves getting more and more into energy poverty, then perhaps leveraging low-cost coal for a period isn't a bad thing to do, albeit, we can't do that forever. You've got to acknowledge that, and you've got to have a plan to move away.
Hello and welcome to Energy Unplugged by Aurora. This podcast features various experts from Aurora having in-depth conversations with key industry leaders, policymakers and academics from all over the world. It explores the hottest topics across the energy market and gives a unique perspective on major energy issues.
Welcome to Energy Unplugged. I'm Hugo Batten, Managing Director of Aurora in APAC. We're very much looking forward to today's discussion. We have Jeff Dimery in today. He's the CEO of Alinta Energy, one of the major vertically integrated utilities in the Australian market. Jeff's had a long and distinguished career in Australian energy, and prior to Alinta, he had senior roles in particular at AGL, another Aussie gentailer. Jeff, welcome to Energy Unplugged. We're delighted you can join us.
Thank you, Hugo, and it's a pleasure to be here.
Let's potentially start with the current crisis that has, I suppose, engulfed Australia's energy market over the last few months. We're recording this on the 18th of August. And for our international listeners, it really has been unprecedented times in the Australian market. The NEM, the National Energy Market on the East Coast, was actually suspended for about a week, and we've seen sustained high prices and some of the structural challenges that have been kept at bay kind of coming to the fore, particularly around security of supply, availability of some coal plants, commodity prices, these types of things. Jeff, any reflections for our international listeners on how we've gotten here? How would you summarise the current situation in Australia?
Hugo, I think it's basically been the perfect storm. Essentially, we had a number of coincident events occur, culminating in a suspension of the market. So for international listeners, we're not immune here in Australia to the geopolitical events that have been going on overseas. So Russia's invasion of the Ukraine and the impact that had on global gas and coal pricing. Those issues have been, caused contagion back into the Australian energy market and have escalated input costs, even though we are a net producer of gas and an exporter of LNG. With the globalisation of energy and international market linkages, that put significant pressure on input costs for thermal generation. In addition to that, we had an early start to winter, and it was a return to historical winter weather patterns that we hadn't experienced for a few years here in Australia. So demand was up. And then on top of that, we've been going through the transition, just like has been occurring elsewhere in the world, moving towards a lower emissions intensive renewable generation. And despite the fact that it was cold and we were losing a lot of solar as we went into the winter period, and it was quite still, unusually so. Yeah. So we had lower renewables, we had higher thermal costs, and then on top of that, exacerbating all of that, was that we had really poor performance in the underlying coal fleet that we have here in Australia. And I think, that largely was a consequence of having an oversupplied market leading into this event, where renewables had been brought in over the top of thermal generation that hadn't been retired, driving down spot pricing and forward contract rates, leading to some thermal generators to cut costs by shortchanging their sustaining CapEx programs and the like, and eventually that caught up and culminated in that perfect storm.
Yeah, absolutely. I suppose the question for here, and again, for our listeners overseas, we've just got a newly elected centre-left federal government who's kind of come in just as this crisis, I suppose, was hitting its peak. And I think the question they're grappling with is, how do we reform the system such that even when we are facing these kind of perfect storm events, they are more manageable? I mean, the answer, I think, is that short-term options are relatively limited because it takes a long time to shift energy systems. But it does feel like, theoretically, Australia's well-positioned long-term for the energy transition. But what are our options to make sure that this doesn't happen again, or if it does, it's slightly less severe and we don't have to suspend the whole market?
Yeah, look, I think if you look at the performance of the publicly listed energy companies here in Australia, and they're going through the reporting season right now, the results are, by historical standards, been very poor, very low. One of the ways that you would expect better performance in the future from those companies would be, whilst they keep assets in the marketplace, they must be maintained. So I think there'll be an increased focus around their risk management when it comes to power generation, preventative maintenance programs and the like, security of fuel supply. I think people become a little bit complacent in the lead up to the events that occurred. So there are things that will happen within the confines of an organisation and sitting within the risk management parameters of that. I think there is a learning, again, and we'll probably talk about this quite a bit, but I constantly look to the European market to get a guide as to where I think we're heading in the Australian market, and it's been a really good indicator. I think the caution for me here is, if I look at what's going on in Europe, where, in the UK, they're falling back onto nuclear. In France, they're doing that as well. In Germany, they're talking about restarting some coal-fired power stations. I guess what I'm saying is that we really need to make sure that as we exit assets, we do so when we've put a solid foundation around the future supply, and not take the risk that ultimately we're seeing play out in Europe, where you exit assets too early before that supporting infrastructure exists. So, my cautionary tale and observation would be to government is that we need to ensure, before we go switching assets off, that the new assets that we're building, the construct of the infrastructure, is fit for purpose and can do the job.
Yeah, absolutely. And let's definitely come back to that, because particularly in the context of capacity markets, I'm keen to touch on those topics. Before we get into that, I mean, there's few people in the country who know more about running a vertically integrated utility than you. And I wanted to touch on a couple of aspects of gentailer strategy. When you think about the evolving gentailer and what it's going to take to be successful in decarbonising and more fragmented electricity markets, what are two or three of the key capabilities that you focus on with your team? And I'm talking about things here like customer service versus risk management, which you've touched on, rapid and effective asset development. I mean, I suspect it's all of the above, and these are complicated organizations that need to do a number of things well simultaneously. But what do you prioritize with your top team?
Certainly from my perspective, there's a couple of things that really stand out. We have a saying in the business that in retail, you can die the death of 1,000 cuts. And so I'll address that in a moment. Whereas in wholesale, the guillotine comes down and can lop your head off. So I guess I'll start with that end of the business and talk about, there are two things that are critical in the upstream part of the business. That is asset management and operation, and energy trading and risk management. And those two go hand in glove. It's no good having the best trading team in the industry if your assets don't support their activities, and obviously those activities within a risk framework and tolerance that shareholders would expect to see. But that in itself is critical and can set organisations apart. when you go to the retail end of the business, I mean, at the end of the day, we sell a commodity. And so price is very important. And obviously brand, reputation, image, all of those things are important. But consumers, first and foremost, are looking to the competitiveness of the energy that they're buying. And so you need to get your cost to supply or cost of goods sold as low as you can possibly have it. And so through trading and through operations is how you do that. You then get to the front end, which is the interface with customers. And I think more and more it's becoming obvious, and we're seeing again trends in Europe. And I'd call out an organisation like Octopus Energy, who are having enormous success around digitisation and technology, and adopting that technology to produce products that enhance the lives of consumers in many different ways. So whether that be enhancing the perception from consumers around sustainability, convenience, and the like are really important. And the nature of the relationship between the energy company and the consumer is also changing quite rapidly. So what I mean by that is that back a decade ago, we would sign up a customer, we would read their meter, we would issue them with a bill, we would collect the funds, and then we would repeat that process over. Whereas today, consumers, many of them have solar panels on their roof, they're installing batteries in their households.
Yeah.
And so the way that, it's becoming a more circular economy, if you like, in those interactions. And the services that consumers are looking for off the back of that are changing. So getting technology platforms right are really important, and managing the upstream cost component that I've talked about.
You make a really good point in there about just the fundamental and obvious point that the kind of price for customer. It is, shocking to look at, I think, some of the numbers again from Europe and see the percentage of the population living in fuel poverty given rising energy costs. That hasn't yet quite rippled through into the Australian market, because I think we're lagging Europe at the moment by kind of 6 to 9 months. But that certainly, I think, will be a more pressing and salient political issue over the next 6 months here in Oz.
Yeah, look, I agree with that. I think that, you mentioned earlier that when we were talking about the short-term energy crisis, that Australia had brighter prospects for the longer term. I agree with that. And to me, this goes to the pace of the transition and that pragmatic approach I was talking about earlier. If you look at Alinta as an investor, we're investing very heavily. Given our size, I would say more heavily than almost anybody in the Australian marketplace around renewables. We recently developed the Yandon wind farm, which is the biggest wind farm in Western Australia. We've conducted major projects up in the Pilbara where we're combining solar and battery with efficient gas to reduce the emissions footprint and cost of customers producing iron ore in the region predominantly. On the east coast of Australia, we're at the forefront of offshore wind development.
Yeah.
We're advancing pumped hydro projects. So, we're doing all of that, and I'm very much for, we can talk about the design of capacity markets. I'm all for governments incentivising and fostering the advancements in that infrastructure to reduce carbon footprint. But I also think the point that you made around energy poverty cannot be overlooked. And to me, that goes to the pace of the transition. And just like, central banks will raise or lower interest rates and use that as an accelerator or a brake on the economy, I think our politicians need to think about the rate of the transition as that same brake or accelerator on the economy. And that if we find ourselves getting more and more into energy poverty, then perhaps, leveraging low-cost coal for a period isn't a bad thing to do, albeit, we can't do that forever. You've got to acknowledge that, and you've got to have a plan to move away. But I think that needs to be an integral part of our transition and the planning thereof. We can't leave it to market forces to, in my view, determine closure dates around assets of that ilk, because, if you're publicly listed and you've got activist shareholders, are you necessarily making decisions that are in the long-term interest for your non-shareholders? And ultimately, we provide energy, which is an essential service that goes to everybody, not just shareholders.
Yeah, absolutely. Just while we're on Alinta's generation portfolio, I mean, you talked there about offshore wind, which I think is enormously exciting in Australia. Pumped hydro, I know you're looking at batteries and diversified renewables generally. And again, we talked about kind of hedging and risk management. As Alinta builds a more diversified portfolio of assets, or as any gentailer builds a more diversified, but also weather-dependent portfolio of generation assets, that hedging and risk management capability and trading capability clearly becomes more important, but also just fundamentally more complex and hard, I think, a little bit. Is it something where you have to bulk up your trading capability or start using, AI and machine learning to better forecast 5 minutes to 5 minutes in the Aussie market, what's happening with the weather? Presumably, you've already thought about that and are gearing up in that way.
Yeah, that's exactly right, Hugo. You hit the nail on the head. We undertook around about 4.5 years ago, we kicked off an internal project here at Alinta called Project Fusion. And that whole exercise was based around updating and upgrading our systems and our processes here at Alinta. So we spent around about, in total, $400 million putting in a digital billing platform, a digital data lake. But importantly, we also upgraded our wholesale trading systems. We've integrated AI, machine learning into the bidding process that we have for the plant, even at the operations and maintenance level, again, significantly upgrading so that we use technology to help with preventative maintenance and identify issues before they arise. And, I'm really pleased if you look at the performance of the Alinta generation fleet, you'll see that it's been an absolute standout against international standards. And it's because of the adoption of that technology. And obviously, I don't want to underplay the skills and capability and the engagement of our workforce, but it's those things combined that deliver that outcome. And you're right, it's so critical.
Just to build on that and maybe to broaden a little bit, the kind of logic of vertical integration in the Aussie market. AGL, one of your competitors, has had quite, I suppose, a public debate and went through a phase where the board wanted to split generation and retail, but have subsequently backtracked on those plans under pressure from Mike Cannon-Brookes and others. The logic of vertical integration, in my mind, there's almost two countervailing forces. One is, as you identified, the increasing complexity of a more diversified generation portfolio and subsequently greater spot market volatility, and the need for vertical integration to better manage that volatility and take risk away from end users. But at the same time, you are seeing more, particularly government intervention, governments entering the markets to write long-term contracts, to potentially create capacity payments. The New South Wales roadmap is a great example of that. Alinta's obviously vertically integrated, I assume it intends to stay so. Do you still see the logic of vertical integration standing up in more fragmented generation markets?
I do. I should declare, I spent 15 years at AGL, most of it running the wholesale and power generation group. I actually wrote the vertical integration strategy for AGL way back when and started power generation for them. So I'm probably biased in my comment, but I just highlight that if you look at in both the UK and in Australia, when we've been in the energy crisis situation, all of the retail that went broke were not vertically integrated. And I think that tells you something about the risk profile. I would say that whilst it would be suboptimal where governments cap retail tariffs, if you're not vertically integrated, then you can be squeezed between wholesale and retail markets. The one thing with being vertically integrated is that whilst it might be a huge opportunity cost, providing your marginal cost to generate is still below the retail cap price, you can survive. Which is important to get through that cycle. The last point I would just make on this is that my view of where we're heading into the future is that wholesale and retail will come together, and we're already seeing this with the investments we're making in systems. But let me give you an example. I would foresee, Hugo, that what we would be able to offer customers into the future, our retail customers, is an opportunity to co-invest in our upstream assets like our offshore wind, whereby we can use the technology that we get, the SCADA data from the wind farm, match that to the 5-minute consumption data we get at the retail end from the smart meter, and advise a consumer to make an investment, for instance, that is a size that exactly offsets their liability when it comes to their energy bill. And I'm not just talking about the energy component. They could invest up so that they also cover the network cost and any administrative government charges. And so what they would do is not get an energy bill, they'd get an energy statement every month showing the income and the cost associated with their consumption. So if you're a pensioner, and you're worried about things like means testing for pensions and things like that, this is a good way to spend some of your money so that you eliminate a bill moving forward, but you're not earning any income. So, you get positive tax treatment in that way. The other thing that a product like that would enable is people who live in high rise and can't have solar panels on their roof, etc., can then participate in the renewable energy economy, in a meaningful way by investing their capital, just like homeowners do with solar panels and the like. So I think playing both ends of the market, both from a product offering, but also critically from a risk management perspective, will stand the test of time.
Makes total sense. Let's maybe shift to market design. And you and I have spoken about this before. We actually released quite a long podcast last week around capacity markets and providing a European perspective. It's certainly the kind of topic of the day in the NEM. I don't know if the quality of discussion is always great. But again, for our international listeners, the Energy Security Board, in their post-2025 market reforms, has suggested at a high level the introduction of a UK-style capacity market into the NEM, which had formerly been a very volatile wholesale-only market with a 15 grand price cap. It looks as if the ministers, literally, I think it was last Friday, are stepping back from that a little bit and talking about capacity markets potentially only for new capacity or excluding some thermal technologies. You've been reasonably vocal on this issue, and I wanted to ask a few questions. What are some of the key characteristics that you'd want to see to be supportive of a capacity market in Australia? And do you look overseas and say, yeah, I like the idea of that one, whether it's UK or France or PJM or whatever it might be?
Well, I do like the idea of a capacity market, and I guess I can look a lot closer to home to find the answer. The wholesale energy market, or the Swiss in WA, is a capacity market in which we participate, and so we have great insights into how that market operates. And I would highlight that despite Western Australia being islanded from the rest of the national electricity market, i.e. it's not connected, they haven't had security of supply issues. And energy pricing isn't on the front page of the West Australian newspaper every day. It's functioning as it should do. So I think that says a lot about capacity markets. I would also note that in WA, the capacity market includes coal-fired generation, which is owned by the West Australian government. And so that goes to some of the arguments we're seeing play out on the east coast of Australia, where some state governments are saying that coal and gas should be excluded. I would make a couple of points. One is that capacity market is only useful if it ensures capacity. And last time I checked, around about 60% of energy on the east coast of Australia is delivered by coal, let alone then adding, another 10 or 12% with gas. So you're still at around 72%. How on earth would you have a capacity market to meet capacity, which is all designed about being there in times of stress, if you're excluding 70% of your supply? So it doesn't make any sense. What I believe would happen is, in order for that to be successful, you would have to have a capacity market and some other form of market that sits beside it. And that reeks of complexity to me. And it sounds a lot like politics, and trying to address a horse up as a camel or something of that ilk. It just doesn't make sense, Hugo. What Alinta had suggested to the Energy Security Board, and of course I would think this makes eminent sense, is that you have different options for types of capacity. So for instance, if someone is able to provide firm capacity through renewables and battery, and they're prepared to put that up to the market and stand behind it, perhaps you could auction that off for 20 to 25 years. And if you're successful in obtaining the capacity rights to that, that might facilitate development of new renewables and battery storage. Fantastic. However, as a safety net, what we were proposing is that coal and gas not be excluded, but in a few years' time, and no one's building any significant new generation in the next couple of years because the reality is it takes longer to construct than that. But you do an annual review, and what you would do is you would only allocate coal and gas where you had insufficient capacity of renewables and storage or zero emissions, and that as that capacity built up over time, you would allocate less and less to coal and gas, which should tie in with closures and the like in any event, and see a reasonably smooth transition. So that's what we were proposing. I realise for some that's politically not where they want to be. But again, I come back to the discussion you and I were having earlier about the cost of energy and energy poverty. And I think whilst it won't get you there as quick as some people would like, I'm sure it will make it more affordable for people who can't afford energy.
Yeah, and we certainly seem to be potentially heading to a least best complicated solution where, for example, Victoria wants to exclude coal and gas from a capacity mechanism, but is, reasonably publicly paying your lawn to exist, which is, for our overseas listeners, a large brown coal plant till 2028. And at the same time may wind up importing quite a lot of power from New South Wales, which may have different rules in place for a capacity mechanism. And so there's that kind of dynamic in terms of eligible technologies, but also kind of reverse auctions for coal closure, while separate markets for new dispatchable, fast ramping, flexible capability. So I think we do risk layering in quite a lot of additional complexity, in the otherwise sensible attempt to make sure there's sufficient kind of dispatchable capacity on the system.
I agree with everything you just said.
The kind of, in some ways, they're equally as controversial in energy circles, but less commented on in the media is the general discussion about locational marginal pricing. So this is the other potential reform that's being pushed. I spend a lot of time in the States, and Kaizo and ERCOT, for example, have reasonably granular nodal markets. What's your view here? My broad take is we have marginal loss factors. There's thermal grid curtailment. There are quite big sticks if you get your location wrong in the NEM. So why do we need additional signals? John Feddersen, our CEO, takes the opposite view. He thinks you need to reward batteries for building in the right places to alleviate congestion and all those kind of things. What's your take here? Do you want to see it left as is, or are you pro-reform here?
I can see arguments for and against, but I'd probably land in the leave it as it is camp. My background is as, was an energy trader. And so I tend to think of things through that lens somewhat. And I'm thinking about, as you move to more locational pricing, how do you manage that risk? How do you sell products across locations? It's difficult in our market managing the basis risk between Victoria, South Australia, New South Wales, and Queensland. We don't really trade in Tasmania, but that's complex as it is. And so, do you want to introduce more nodes? And I guess what I think would happen is that you would see a significant drop in liquidity in regional locations where people don't have access to physical assets. And I'm not sure that ultimately that's in the interest of consumers. So for that reason and that reason alone, I land in the less is better. And again, I think if I look at, and I'm really stretching my memory here, but, I think there were any number of locational prices in the New Zealand market going back a decade and a half, 2 decades ago, that led to a number of retailers being put into distress because they couldn't manage the risk across all of those various locations. So,
I think New Zealand still has well over 200 nodes, which for a country that's relatively small seems a lot. I completely agree with you, and this is where I get very suspicious of energy market modelling as the answer to market design questions. I think organisations like Aurora can be helpful directionally and to test different scenarios, but it's very hard to build in things like, as you say, liquidity in contract markets into capacity expansion price models. So, I agree with you very much, and don't think some of the market modelling that's being used to support either position on the locational marginal pricing debate is very helpful. Jeff, in the interest of time, I do want to finish up on your career, which has been, as I said, a very long and distinguished one. You've been in the NEM for 20 or 25 years now, and it's clearly been a period of profound transition, particularly recently. This is a question I ask a lot, but has it got harder to run a gentailer now than it was 10 or 15 years ago? Or has it always been a pretty difficult game, and it's the kind of vanity of recent entrants that it's suddenly got harder all of a sudden?
It's definitely harder today than it was years ago. Market participants are far more sophisticated. We talked about technology and AI, machine learning. So the consequences of making mistakes is much higher. Community expectations are far greater. The social license to operate. You're not just concerned about the cost of energy, environmental considerations and brand and reputation that sit along that side, right through to community service obligations, expectations, standards set by regulators and the like. Everything's just going up and up and up. Hugo, so it is much, much harder. People are more informed. We have better systems and processes to cope with that. But that's what do they say? That necessity is the mother of invention, and that's, to my way, been the evolution of being a gentailer.
Yeah, I mean, I've been saying at least for the last year or two now, but I do think that the toughest jobs in the country almost at the moment are running the gentailers in Australia, or running AEMO, and Dan Westerman's a good friend, but that is an extremely tough job at the moment
I don't
as
envy
well.
Dan. I don't envy Dan at all.
Yeah, that week where he had to close down the market, I think everyone's aligned that he's done a terrific job, but certainly took a toll, I imagine. This is another question I ask quite frequently, but we do have a lot of young listeners and people who are interested in energy listening into the show. Aside from Alinta, if you were entering energy today, where would you want to go? Would it be the kind of developers who are out there cracking on with new projects, the big infrastructure funds, sophisticated buyers like the big tech guys, Google and Amazon, some of these like behind the meter VPP aggregator? Like, where do you see the most exciting innovation happening in energy today, outside of Alinta, obviously?
Well, I think the fastest growth area would be in regulation. So if they're looking for a secure job, I think head down the regulation path.
Yeah.
We talked about Daniel, and I think in terms of getting exposure to the entire industry and the changes and that rapid pace, working for someone like the Australian Energy Market Operator, for a young person to build a foundation from which to leverage would be a great starting point. I definitely, if I look back on my career, some of the things I'm most proud of, largely I keep pointing back to development in renewable energy, and I was associated with the establishment of the Clean Energy Council in Australia. Worked with a really talented team to build a lot of the early onshore wind farms, and also developed the largest hydroelectric power station on mainland Australia in the last 50 years, which will be usurped when Snowy 2.0 is finished, but is a record we will have carried for a while. So really, for me, I love feeling like you're leaving something which is much greater than yourself. So if they have the skills and capabilities working with developers, and I might add, we've got an extensive development group here in Alinta, so it doesn't have to be with standalone developers or infrastructure funds. In fact, infrastructure funds are talking to us about investing into our project. So well, let me just say, this is a free ad for Alinta. Give us a call.
Good stuff. One final question, and I finish every interview with this. Who do you read or listen to in the energy space that you think is always good, thought-provoking, and relevant to your work in the private sector?
Yeah, a really good question. I guess if I reflect on that, firstly, I would say that the most influential person in terms of their thinking, and this might surprise you, is Sir John Monash. Sir John was he was the original chairperson of the State Electricity Commission of Victoria, and he really led the industrial revolution around utility scale electrification in Victoria. He also did a number of other things. He was a general in the army as well. If I quote him, equip yourself for your life, not solely for your own benefit, but for the benefit of the whole community. It still resonates really strongly with me today. And I guess, we've just been talking about things that I think about when I look back on my career. I guess in more recent times, Ross Garnaut and the work that he did around climate change review in 2008, and even more so more recently, Kerry Schott, who was the previous chairperson of the Energy Security Board, and also people like Matthew Warren, Danny Price, and Tony Wood. I really value their commentary and observations on the market.
Yeah, that's a great list. And I must admit, my energy reading doesn't go back to Sir John Monash, but I'll do some Googling after this. And have a look. I mean, I knew him as the wartime general, not as the utilities thinker. So I'll have to dig into that after this. Jeff, that's absolutely terrific. We're hugely appreciative of your time, and we've covered a lot there, I think, in just on 40 minutes. You are one of the busiest people in Australian energy, and again, we're very appreciative. All the best, and thank you again.
Thank you, Hugo. It's been a pleasure.
That was Hugo Batten, Managing Director of Aurora in APAC, talking to Jeff Dimery, Managing Director and CEO of Alinta Energy. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to subscribe on whatever platform you use. Thanks for listening, and goodbye.